In 1953, a company you have probably never thought twice about did something that quietly changed business forever. General Electric had a boring problem. Paying the workers at its factory near Louisville, Kentucky took too long. So, GE asked a small consulting team inside the accounting firm Arthur Andersen to fix it. Their answer was radical for the time. They brought in a UNIVAC computer, one of the first commercial computers ever installed at an American business, and used it to run payroll. The man who led that project, Joe Glickoff, became known as the father of computer consulting. That single payroll job was the seed of what is now Accenture. For the next several decades, that seed became the most dependable idea in corporate technology. Every time a new wave of computing arrived, mainframes, then office networks, then the internet, then the cloud, big companies had no idea how to install it themselves. So they paid Andersen Consulting, renamed Accenture in 2001, to do it for them. The deal was always the same. Whatever the new technology is, we have the army of people who know how to bolt it onto your business. By 2025, that army had grown to around 779,000 employees and nearly $70 billion in yearly revenue. It became one of the most reliable money machines on the entire stock market. Here is the twist. The market is only now waking up to. The company that got rich installing every new machine is being threatened by the newest machine of all. Because this time, companies are asking a different question. Why pay a giant team of consultants when AI can do large parts of the work on its own? This week, that question stopped being theoretical. On Wednesday, Accenture had the worst single day in its history as a public company. The stock fell almost 18% and lost more than $15 billion of value in a few hours. What makes it strange is that the results were good. Profit came in at $3.80 a share, up 9%. Revenue grew 6% to $18.7 billion. Investors were not reacting to the past. They were reacting to the forecast. Management cut its full-year growth target to about 3 to 3.5% and warned that next quarter would come in lighter than expected. The reason they gave was delayed client decision-making, which, in plain terms, means their customers have started freezing projects. Three things are driving that freeze. Corporate technology budgets are flat this year, so there is no new money to compete for. The money that is moving is going into small, cheap AI experiments, rather than the large multi-year contracts Accenture was built on. And its U.S. federal government work has slowed enough to drag overall growth down by as much as 1.5%. The war in the Middle East removed another $400 million of regional revenue in a single quarter. What the company did next told its own story. On the same day it admitted growth was slowing, Accenture committed $4.18 billion to buying other businesses, mostly in cybersecurity, including a stake in a firm called Dragos. That is nearly double what Accenture earned in profit all of last quarter. With its own stock sitting at its lowest price in years, management chose to buy other companies rather than buy back its own shares cheaply. The insiders have been moving in one direction only. Over the past 18 months, Accenture executives sold a net of more than 100,000 shares and bought none. Chief Executive Julie Sweet sold her own stock earlier this year at prices between $240 and $290. It now trades near $130. She sold at roughly double the current price, and not a single executive has bought as it has fallen. The economy gives them no cover either. This week, the Federal Reserve held interest rates at 3.5 to 3.75%, but its own projections now point toward another rate increase this year rather than a cut, with inflation still above 4%. Expensive money is exactly what pushes companies to delay the big technology projects that fill Accenture's order book. There is a counterargument, and it lives entirely in the price. Accenture now trades at around 11 times earnings after spending most of the last decade near 25 to 30. The stock is down about 50% this year, yet the average analyst target still sits near $235, while the shares trade around $130. Revenue is still growing, and the dividend is still being paid. So the whole story comes back to where it began, with a machine. Either the market has overreacted to a profitable giant going through a rough patch, or it has spotted that the same kind of technology Accenture once installed for everyone else is now quietly replacing the work it sells by the hour. The number that decides it arrives next quarter, and it is new bookings, the value of fresh contracts signed. For now, the stock is priced as if the machine wins.